Welcome to the Sand to Pirls Stock Market Commentary for Market Week ending Friday, September 26, 2014. Market breadth. With this past week's market decline, our bull-bear point and figure ratio fell from 1.06 to 0.66, dropping into bearish territory. The total count of securities in bullish or bearish patterns rose 1% to 2,063. The count of bearish stocks increased 25%, while the count of stocks in bullish patterns decreased 22%. The Sand to Pirls P&F Market Breadth Summary Chart shows us a market now 1 week in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 222 points for the 7th decline in 17 weeks. At a negative 290.62 points. It continues below all 9 tops above plus 100, has fallen below the July 2012 bottom, and continues above all 6 other bottoms below minus 100 in the last 35 months. Market Gauge Volume Analysis. In this week's volume analysis, the Nasdaq 100 Trust ended in neither accumulation nor distribution mode. In the last 2 weeks, it had 1 accumulation day and 1 distribution day. Of the other indexes, both the Diamonds Trust and the S&P 500 Deposit Receipts ended in neither accumulation nor distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq 100 Trust also ended in neither accumulation nor distribution mode. Momentum. The CCI 20 fell dramatically, now has 5 consecutive days below zero, and remains outside the plus or minus 50 range for a valid zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 12 weeks ago, while the daily CCI 20 began a Woody's uptrend 5 weeks ago. At 71, the CCI 20 weekly continues outside the plus or minus 50 range for a valid zero-line reject. Industry rotation the last 2 weeks. 4 of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish, Comp Tech continues in the top 5. Semis and S&P Retail have entered the top 5. Oil Services continues in the bottom 5. REITs has left the bottom 5. Gold and silver continues in and now leads the bottom 5. Bearish, brokers and banks have left the top 5. Focus this week, Debt Rattle, September 25th, 2014. It's the dollar, stupid. The following are some excerpts. There are substantial and profound changes developing in the global economy, and in my view, we should all pay attention, because everyone will be greatly affected. Metal markets, be they gold, silver, copper, or iron, exhibit distress and uncertainty. Prices are falling, or at least seem to be. The main reason metal prices are dropping is, plain and simple, the US dollar. To claim that this is the market at work makes no sense anymore. Today, central banks, for all intents and purposes, are the market. Why the Fed moves the way it does, the moment it does, in its three-pronged combo of fully tapering QE, hiking rates, or at least threatening to, and pushing up the greenback is not immediately clear, but a few suggestions come to mind, some of which I mentioned earlier this month, in the Fed has a big surprise waiting for you, and in what game is being played with the US dollar. My overall impression is that the Fed has given up on the US economy in the sense that it realizes, and mind you, this may go back quite a while, that without constant and ongoing life support, the economy is down for the count. And eternal life support is not an option. Even Keynesian economists understand that. Add to this that the real economy was never a Fed priority in the first place, but a side issue, and it becomes easier to understand why Yellen et al. Choose to do what they do and when. The higher dollar will bring some temporary relief for Americans in lower prices at the pump and for imported products in stores, for example. Higher rates, however, will put 1.5 tons of pressure bearing down on everyone who's in debt, and that's most Americans. The idea is probably that by the time this becomes obvious and gets noticed, we're far enough down the line that there's no going back. Besides, we could be in full-scale war by then. 1 or 2 IS attacks in the West would do. To reiterate, there is no accident or coincidence here, and neither is it the market reacting to anything. That's not an option in this multiple choice, since there is no market left. Whatever you do, don't take this lightly. A major move is afoot. This week's commentary submitted by Donald Pirls, www.s2pmarketsignal.com. Thank you for tuning in for this week's Santu Pirls stock market commentary. Hoping that you've had a pleasant and peaceful weekend, that you have a great week coming up, and wishing you true success.